Okay, good afternoon and welcome back everyone to our options education webinar series. My name is Tony Zhang. I'm the chief strategist here at OptionsPlay. And today we're going to be embarking on our intermediate options trading course where we're going to be talking about how to select optimal expiration dates and strike prices. Now, this topic is really going to be somewhat actually easy to understand. It is going to be somewhat counterintuitive. This is probably one of the more counterintuitive parts about options trading, but once you wrap your head around this, it's really useful for selecting your helping you select your expiration dates and strike prices for all your strategies because it's the general same overarching framework for regardless of what type of strategy you might choose. Now, different strategies do have slightly different variations of what I'm going to teach you here today. So we're going to talk about what the overarching theme is. We're also going to discuss what specific expiration dates and strike prices apply for specific types of strategies. And then we'll go through a few examples to show you. But overall, fairly simple concepts that we'll be going through here today. Now, let's go ahead and get started here. I just want to make sure everyone can hear me. If you can, please type yes into the chat window. And while you do that, just a quick disclaimer, what we're going to discuss here today is purely for demonstration purposes and not a solicitation or recommendation to buy or sell any specific securities. Okay, great. I see a lot of yeses. So let's go ahead and get started. Now, for those of you that are brand new to OptionsPlay, if this is your first time, welcome. We do these education webinars every single Thursday to help you better understand how to utilize options in your portfolio. Will be showing you our platform so that you can follow along. You can sign up for a free trial for 30 days using the link that I have here on my screen. And I'm posting it into the chat window for those of you that are brand new so that you can follow along at your own pace. You get a free 30-day trial, gives you access to the education, the platform, our daily trade ideas, as well as our weekly market outlook, which we're going to do tomorrow morning at 9 a.m. So I hope to see many of you there. So you can sign up using that link for your free trial. Now, like I said, today is going to be our first part of our intermediate options trading course. Technically, we started that last week, but we did a special event to help you better understand how to position for a potential sell-off in the markets and how to hedge your portfolio. That was the first piece, but today what we're really embarking on is our intermediate options trading course. If you're a beginner, no worries. This topic I think is really relevant for everyone. But I do recommend that if you're brand new to options trading and you're starting your learning process, that you actually go back and watch the beginner's options trading course before you continue on with our course. All of our webinars are recorded, and I'll be sending you guys a link here when we're finished here later today. So today, what we're predominantly going to be talking about is expiration dates and strike prices. Now, for many traders, this is really the bane of your existence when it comes to trading options, because when you're trading options, you simply have a lot of options. So if you look at an option chain, most brokerage firms have a page that looks like this, which gives you hundreds, if not thousands, of expiration dates and strike prices. It's many times very daunting to try to figure out where do you want to start, right? And this is presuming that you already know what strategy you want to trade and you have a general understanding as to what your outlook on the underlying stock is, which we don't necessarily always have. And then you have to pick from the page that looks like this, where do you want to start? And sometimes that's actually quite daunting. So today we want to talk about an overarching framework that helps you understand how to navigate this type of page so that regardless of what type of strategy you're looking at, you have a general understanding as to where do you want to start, okay? So we'll talk about expiration dates first, because that's usually the first thing that we select. Then we'll talk about strike prices, and then we'll talk a little bit about the different strategy examples. We'll go through a few popular trading strategies and how we select expiration dates and strike prices for those specific strategies. And the upcoming events that we have next week, we're going to be talking about credit vertical spreads. This is for those of you that have a little bit more experience trading vertical spreads. Selling credit spreads is a little bit more complicated than buying debit spreads, which we covered in our beginners options trading course. Now we're moving on to more advanced topics, credit vertical spreads, which we've been doing a lot in our Daily play trades, likely, I believe tonight we're going to be doing the same type of trade again for tomorrow. So very popular strategy in this current market environment where volatility is still relatively elevated, but things are pretty quiet in terms of directional movement. These are the best times to be collecting premium and selecting, using strategies like credit spreads, so that when you do get a little bit more movement in the markets, then we want to utilize the income that we receive to go out and buy some calls and puts and perhaps some debit spreads that we've talked about in our beginners course. And then what we'll do is the week after, we're going to continue to go back and we're going to keep looking at our live market outlook. Basically, what we do is we go over everything that we covered in our beginners in our intermediate options course, and we do a summary. We basically look at the markets, we take what we've learned, we show you how we apply it to the live markets, and we give you an opportunity to ask questions. Not a lot of teaching on May 28th. We predominantly focus on what questions you have with the things that you've learned, and we try to answer those questions before we move on to more education. So that's the framework that we're generally going to be utilizing throughout 2020, is this new format of teaching, but then making sure that we always have time to go back and reflect and look at what we've learned and answer your questions before we move on. So let's go ahead and get started here with respect to expiration dates. So to understand where should you choose your expiration dates, right? Because when you look at an option chain, you'll see that there are many times dozens of expiration dates. And especially if you look at most of the major or large cap names or mega cap names, you have weekly options, you have monthly options, you have quarterly options, you have leaps going all the way out to January 2022. And then if you're looking at stuff like SPY, many times you have, 3 dozen, 4 dozen expiration dates. So it's very daunting many times as far as figuring out where do you want to choose, right? So look at something like SPY. There are tens of expiration dates, and it's very difficult sometimes to figure out where do you want to start. So in order to understand how should you pick your expiration date, the first thing that you should understand is how does an option actually behave as they are further away from expiration, and how do they behave as they get closer to expiration. So the chart that I have here on my screen gives you a rough outline of how an option's value behaves as it approaches expiration. Now, this is not to scale, and this is slightly exaggerated, but it's done so in a way to teach a lesson, if you will. So what I have here on a chart is the value of an option, which is denoted by the y-axis, and then the time to expiration denoted here on the x-axis. And what you basically see is that the value of the option will decay as you get closer to expiration. Now, this is what we call time decay, or the theta Greek of your option. Now, one thing that you'll notice is that for each unit of time, so let's say this is 1 year's time, right? So this is, let's say, 12 months out here, or 1 year. For each unit of time, in this particular case, we're going to use 3 months of time. For each unit of time, you get a slight decay in terms of the value of the option. Now, from 12 months to 9 months, as you notice, that decay is relatively small. From 9 months to 6 months, that decay gets a little larger. From 6 months to 3 months, that decay gets even larger. And in the final 3 months, that's really when most of the decay actually happens. So you actually, generally speaking, get more decay in the last 3 months than what you generally get in the previous 9 months. So this is the first thing to understand, because the value of your option will decay very fast as you get closer and closer to expiration. So think about the value of an option, right? Think about when you're buying an option, what do you want the value of that option to do? When you're selling an option, what do you want the value of that option to do? And the answer is obviously when you're buying, right? When you're buying an option, you want the value of that option to go up. When you're selling an option, you want the value of that option to go down, right? That's pretty simple to understand, right? Everyone understands that. Please type 1 into the chat window that when you buy something, you want it to go up in value. When you sell something, you want it to go down in value. So if you look at this chart, right, and you're looking at this chart and you say, well, if I'm buying an option, where would I want to choose an expiration date that fits my thesis, right? So right off the bat, what you can do is you can figure out where you don't want to pick an option, which is if you're buying an option, you generally probably want to avoid this general section of the curve, because when you're buying, you don't want the value of your option to be decreasing or rapidly decreasing in the final days to expiration. What that means is that when you're buying an option, you generally want to pick something out here, possibly even out here, because when you're buying, right, you want the value of your option to increase. So you want to make sure that you decrease time decay or time value of your option. And the best way to do that is by selecting an expiration date that's relatively longer dated. Now, again, like I said, this chart is exaggerated, right? This is not to scale, because if you looked at this chart, you would say, whoops. If you looked at this chart, you would generally say that I only want to buy options all the way out here. But reality, this chart is a little exaggerated. It probably looks closer to something like this. So what you generally want to do is you want to avoid buying in that last month or so, right? So if you're buying an option, you generally want to start off the rule of thumb roughly is about 1.5 months or greater. So anything greater than 1.5 months is usually suitable for buying. Now, the one thing that you have to remember is the fact that the longer you go out, the more expensive your option is. So, and also the longer you go out, the less liquid something is. So there's usually a range as far as when you want to choose. And the other thing you also have to think about is, what is your time horizon, right? Meaning if you're bullish on a stock for just a few days, then you don't need to buy an option that's more than a month, month and a half out, because you're only holding on to it for a few days. If your outlook is a year out, then you obviously want to buy an option that's at least 1 year out, right? So that's something that you have to factor into, that's based on your personal outlook of the underlying stock. But the lesson here is that if you're buying an option, what you generally want to avoid is this particular time frame, which is roughly 1 month, 1.5 months from expiration, because during that time, that's when the value of your option will decay the fastest, and that will erode the value of your option as it tries to go higher, right? So if you get the direction correct, but time value starts to work against you, you really offset a lot of the gains that you have in the underlying stock. So I want to make sure that makes sense to everyone before we move on. So please type 2 into the chat window if that makes sense to you. Okay, perfect. And I see a couple of questions, and I will get back here to your questions here in a second. So now let's talk about if you're selling an option, right? If you're selling an option, where do you want to be? So I think here, just based on what we just said before, it's pretty clear that if you're selling any type of options, you generally want to avoid selling options out here, because yes, you will have direction working in your favor potentially, but theta's not really working very, very much for you, right? So you can hold on to an option for 3 months and have almost no time decay work in your favor. When you're selling an option, you want to focus more on the very short term, because you want the value of your option to decay to zero. That's why you're selling that option. You're hoping that the value of that option goes to zero. So it's, generally speaking, whenever you're selling options, you want to sell shorter dated options. So that's just the simple overarching theme that I want to teach you by utilizing this chart. So again, pretty simple to understand. So if this makes sense to you, please type 3, that when you're buying, you want to buy out here. When you're selling, you want to sell out here. Okay. Now, but when you look at a chart like this, I think it's pretty clear, right? Now, what challenges most of us when we actually come to doing this in our portfolios is when we look at an options chain, right? Because when you look at an options chain, let's go back to, I'm going to use Facebook as an example, because it's trading close to $200. It's trading at 206 right now. And I want to challenge, and the reason that I want to challenge this is because many times when we're buying an option, what we're told to buy low, sell high, right? So that is, in my opinion, the most counterintuitive part about options trading, is because if I choose something like, let's say, a 15-day option versus a 30-day option versus a 90-day option here. So I'm looking at the May 29th, which is 15 days from expiration, a June, which is 36 from expiration, and a August from 99 days from expiration. One of the things that you'll see is that the shorter dated option, let's just choose an at the money option. Let's say I choose the 205s. 205s are trading at 530. 205s here are trading at 870, and then the 205s out here are trading at 1580, right? So those are my 3 choices: 540, 870, 1580. So when we're buying, what do we want to do? We want to buy low, sell high, right? Which is why we tend to find many investors take this more counterintuitive technique of buying shorter dated options because they're cheap. And you're thinking that if I buy, I want to buy as low as possible. If I can buy something for $5, why should I pay $8, right? And that's really where, in my opinion, the most counterintuitive part about choosing an expiration date is because when you're buying, you want to buy something cheap. So people tend to gravitate towards trading a shorter dated option. So, and maybe comparing a May to a June is not fair, but many times when you're comparing maybe a June weekly to a June monthly, and you say this is $7, this is $8.65. Well, let me pick the cheaper one because I want to buy low, sell high. But that's really where the counterintuitive part about selecting expiration dates, I find that most people, but because what they do is they simply gravitate towards what's cheaper and they buy the shorter dated option. When in reality, it's the exact opposite. What you should be doing is if you're thinking about two different expiration dates, you should always focus on the longer dated option because you're actually going to have slower time decay. Because both of these trades, maybe you only hold on to it for 2 weeks. Guess what? The June option that you purchased that's a little bit more expensive will suffer smaller amounts of time decay during those 2 weeks that you hold it, which will generate a higher profit for you in the long run. So that's why whenever you're trading expiration dates, whenever you're buying, you want to buy longer dated options. And then when you're selling, that same counterintuitive part makes it a little difficult many times from selling options, because think about when you're selling a cover call. Let's say you're thinking about selling a cover call on Facebook, and let's go a little further out in terms of strike prices. Maybe you want to sell a 215 strike, and you say to yourself, well, I can sell the 215 in May for $1.50 or so, $1.45. The 215s are collecting $3.15 here. If I go all the way out to June, I'm going to collect $4. So if I'm selling, I want to sell as high as possible, or I want to collect as much income as possible. So we tend to see that when people are selecting expiration dates for selling, they tend to go longer dated because they see, oh, I'm going to get more premium, I'm going to get more income. But in reality, what you're doing is you're getting income at a much slower rate when you go further out in time. So notice here on the 15th, right? So let's compare the 15th and the June one. So let me remove some of these expiration dates so that we're just looking at the ones that we want to look at. Let's say we're just comparing the May 29th, which is 15 days from expiration, and the June 12th, which is 29 days from expiration. One is twice as long as the other one. So here I'm selecting the 215s. I'm going to collect roughly $1.40 something. Let's just call it $1.45. On the 215s here, I'm collecting $3.30 or so. So here I'm collecting $1.45. Here I'm collecting $3.30. This is actually a case where you're actually getting a little bit more for the longer dated options. Now, I wonder if it's because, no, I don't think Facebook has earnings coming up, but this is an interesting thing. So one of the things that you'll notice is that here you're getting 36% vol, here you're getting 38 vol. So here you're actually getting a little bit more premium here for the longer dated option. So this is a little bit of a edge case, if you will. Normally the longer dated options trade at a lower vol. In this particular case, these June options are actually trading at a higher vol. Notice how if you go out to August, they trade at a much lower vol, 24. I'm curious as to what's happening here as far as why that's happening, but the general rule of thumb is that when you go further out in time, you generally do not get paid the same amount of premium. Now, I also think that it's not entirely fair to select the 215 strikes for the same expiration date. Normally, I'd have to pick a slightly higher strike price because I'm going out twice as much in time. So here, I think to compare like for like, here I'm choosing a 24 delta call. Here I'm also collecting a 27 delta call. So these two are relatively similar. Notice how here I'm collecting about $1.45 for the Mays, which is 15 days from expiration. For the same delta going out twice as long, I'm only getting about $2.50. So I'm not getting twice as much premium. I'm actually getting less than twice as much premium. And that's the reason why whenever you're selling an option, I would rather sell a 25 delta 15-day option and do it twice in the same amount of time that I could sell this longer dated option, because if I sell this option twice for $1.50, and I can do that twice, I'm going to get roughly $3 in income as a total for those 30 days. But here, if I sold just a 30-day option, I'm only getting $2.50. So what I'm losing out on here is roughly 50 cents in extra income. So even though it sounds like in this particular case that I'm getting more income here, but in the long run, in the next 30 days, if I sell this type of premium that's longer in time, I'm actually going to collect less premium in the amount of time. If I sell shorter dated options more frequently, it adds up to more premium in this particular case, about 50 cents more than if I sold the 30-day option at the same delta. So I want to make sure that makes sense, everyone. So please type 4 into the chat window if that makes sense. So yes, I understand that the strikes are different, but I'm choosing the same delta because whenever you're choosing an option to sell, I wouldn't sell the same strike price if it was twice as further out in time. I would sell the same delta. So that would be the same comparison. I wouldn't compare the same strike price. So good observation, but that's why I chose the 215s here and the 217 and a halves here, because I'm going out twice as far in time. I need to choose different strike prices for each one. Okay, so that's the general rule of thumb, that whenever you're buying versus selling options, that's how you want to choose that. Now, I just used the live example instead of using this particular page that I originally had an image of. I think the live page made it a little easier for me to show that example. So just to quickly summarize, whenever you're thinking about an expiration date, it's fairly counterintuitive when you're thinking of buying options to buy longer dated options because they're more expensive. And it's counterintuitive to sell shorter dated options because they're cheaper and you feel that you're getting less income. But in reality, what's happening is that when you're buying a longer dated option that's more expensive, you're going to receive smaller time decay, or you're going to have a smaller amount of time decay for the same holding period than if you chose a shorter dated option. So shorter dated options are cheaper, but they're going to be more expensive for you through time decay, and vice versa. When you're selling, you're going to feel like you're getting less income, but because you're able to do it more often, it will add up to more income than if you sold a longer dated option. Okay, so not too difficult to understand, just a little counterintuitive when you're learning this. So if that makes sense to everyone, please type 5 into the chat window. Okay, perfect. And Janice, I see your question about delta, but I'm going to come back here and answer that. So now that we've covered expiration dates, now I want to talk a little bit about strike prices, okay? Because expiration dates, one thing; strike prices, there are a lot of strike prices, and many times when you're thinking about buying versus selling, this is also a second part of the very counterintuitive part about buying versus selling options, is where do you choose your strike prices. So in order to understand a little bit about strike prices, here I have a chart that actually shows you, before I showed you how the value of the option erodes as they get approached to expiration. But here, what we actually show you is the speed at which they erode, depending on whether you're looking at the money, in the money, or out of the money option, because those are your three choices those are your general choices when you're selecting a strike price, right? Do you buy something that's in the money, out of the money, or at the money, or if you're selling, the same thing. So if you look at this chart, it becomes a little bit obvious again. If you're buying, what do you want? And if you're selling, what do you want? So first of all, when you're buying, you want the value of your option to go higher. When you're selling, you want the value of your option to go lower. So if you're buying, where do you think you generally want to buy? Not only do we have to think about it, so we've already talked about expirations when we're buying, right? We want to buy generally maybe somewhere in kind of this sort of zone, if you will, right? Because we want to avoid at all cost buying something that's going to evaporate in value very quickly. So we want to buy something here, but where do you think you want to buy if you're buying an option? Do you want to buy in the money, at the money, or out of the money here when you're buying? So I have a couple of interesting answers here. Someone said at the money. The answer is that it's actually somewhere in between. It's somewhere in between at the money and somewhere in between in the money. So somewhere I would say here is generally the right time place. Generally, what you want to avoid is buying out here, because out of the money options will evaporate, will actually decay in time value faster in terms of the premium that you receive. And in the money options, many times, the further in the money you go, the less time value you're paying. But at some point, there's diminishing returns because it just becomes so expensive. you might as well just buy the stock. So that's why slightly in the money is usually where you want to buy your options. Now, and I'll show you when we look at the options chain why when you're just looking at an option chain, it's actually that doesn't seem like the right place to buy. But when you look at a chart like this, it becomes obvious. Now, when you're selling an option, where do we want to sell, right? So we talked about when we're selling an options in general, for selling, we want to be focused more in this time zone, right? Because we want the value of your option to evaporate. So when you're selling an option, where do you want to sell? In the money, at the money, or out of the money? The answer is out of the money. Exactly. So out of the money options will decay the fastest, right? So when you're selling, you want to sell out here. When you're buying, you want to buy out here. So in order to better understand this, I think what we'll do is we'll just look at the option chain as well, because that will also show you what I mean by this. So we'll go back to showing you, let's say 6 strikes. We'll look at all the expiration dates. So the part that I think is most counterintuitive, right? So let's not look at all the expiration dates. Let's just go to the expiration dates that we might want. So let's say we're buying an option, meaning let's say we're buying a call option on Facebook because we think Facebook is going to increase in value. So we want to buy a call option. So, you know, as you can see here on your chain, you have in the money options that are very expensive, out of the money options that are very cheap. Guess what? When you're buying an option, what do we say? You want to buy low, sell high, right? So naturally, when you're buying an option, people tend to gravitate towards strike prices like this, out of the money options, because guess what? They're cheap, right? Why would I pay $12 for something that I only have to pay $7.25 for or $5.30? And this is really where it becomes, it's not just how much you're paying, but what are you getting for what you're paying? Because you have to also factor into delta. Delta tells you how much leverage are you getting. So for every dollar the stock goes higher, how much does your option increase by? So yes, these are cheap, but what they're going to get is very low delta. So even if the stock goes higher, you're actually making a smaller percentage of those gains. And this is really where you're trying to figure out where is the sweet spot. And that's really where, based on time decay, you want to focus your attention more around the 205 range, slightly in the money. So here's about a 55 delta. So the first in the money option here, it's going to be more expensive. But when the stock moves higher, you're going to get 55 cents on your dollar. You're actually going to get a little higher because gamma kicks in as well. Versus here, yes, you're choosing a significantly cheaper option, but you're paying all time values. So you're going to get less leverage and time value is going to erode at a faster pace out of your $5.40 that you're paying for that out of the money option. So very, again, counterintuitive way that when you're looking at the options chains, we tend to find that people, when they're buying, they tend to buy shorter dated options out of the money. That's usually the worst place to be buying. And where you're selling, we tend to find people sell longer dated, closer to the at the money options, because that's where they think that they're getting the most premium or the most income. But in reality, in the long run, that's actually where it works against you. So same thing when you're selling an option. So when you're thinking about strike prices, when you're selling, same thing, right? Because when you're selling, you tend to want to sell something that gives you the highest amount of premium. So if you're looking at something like this, let's say you're going out, maybe when you're selling, let's say you're going out to June, which is 36 days away. Let's say you're selling a cover call and you're saying, should I sell the 225s? Should I sell the 220s? Should I sell the 215s? And this is, again, where you have to also factor into delta, meaning what is the probability of this call or put expiring worthless, right? So on some strategies, you might want to be assigned on that, right? So that's some of the things we're going to discuss here next is strategy specific. What I'm teaching you right now is more of an overarching theme. We're not getting into specific deltas. We're not getting into specific expiration dates. This is meant to just be a general rule of thumb. And then things will change a little bit depending on which strategy you're referring to. So, but generally speaking, whenever you're selling, you want to sell something that's out of the money because you want that value of that option to evaporate as quickly as possible with the least amount of risk that you get assigned on that. So that's really kind of where you're trying to strike your balance. And that depends on what strategy you're trading. So that's what we're going to talk about next. But generally speaking, whenever you're selling an option, you always want to start selling out of the money options because those are going to erode and they have a higher probability of that call or put expiring worthless, which is what you want whenever you're selling an option. Okay, so does that make sense? Does that make sense, everyone? Please type 6 into the chat window if this makes sense to you. Okay, perfect. I see a lot of 6s. So let's go ahead and start looking at some examples. And just before we do, just a quick summary again, whenever you're choosing expiration dates, this is not difficult. It's just counterintuitive that when you're buying, you want to buy longer dated options, which are going to look more expensive when you're looking at an option chain. But what they're going to do is they're going to decrease or decay at a lower rate. Whenever you're selling options, you want to sell a shorter dated option, which again, seems counterintuitive because when you're selling, you want to collect the highest amount of income, highest amount of premium. The shorter dated options have the least amount of premium. But what you realize is that when you sell shorter dated options, you can do them more frequently, and it's going to add up to be more income than if you choose a longer dated option, which if you just look at the chains, seems like it has higher premiums. Okay. And when you're saying strike, when you're figuring out what strike prices, when you're buying, you generally want to start either at the money or slightly in the money. Those are actually your best bang for your buck as far as buying. And then when you're selling, you always want to sell out of the money options because those are the ones that will actually give you the best probability of that call or put expiring worthless while giving you time decay that works the fastest or collecting your income in the fastest possible manner. So that's the general rule of thumb. Like I said, not difficult at all, just counterintuitive when you're looking at an options chain. So now let's take a look at some of the strategies, right? So when we're looking at a strategy, first, two that I'm going to cover are cover calls and cash secured puts, because almost 40 to 45% of trading volume are in these two strategies alone. So I want to obviously pick strategies that are most commonly traded. So with a cover call, general rule of thumb, obviously shorter dated options, usually 30 to 45 days out is a good starting point if you're thinking about what expiration dates. You generally don't want to go longer than 45 days when you're selling cover calls, because if you do, you will generally find that you're going to be able to collect just as much premium. You're going to collect more premium than by selling, 2-3 week options back to back, and you're going to collect, generally 1.5 times more premium than if you sold a 45-day option. So 45 days we generally find is the higher end of the spectrum when it comes to cover calls, and you generally want to sell cover calls that are pretty far out of the money, the 15 to 20 delta. So something that has a pretty low probability of the stock getting above that strike price and for your stock to be called away. So if we're looking at a chain here, like in Facebook, let's say I'm selling a 36-day option, which is somewhere in that range. What I generally want to find is a cover call that is roughly in the 15 to 20 delta, which in this particular case would be the 225s. This is a 17 delta. 17 delta means that there's only a 17% chance that Facebook stock by June 19th will be above 225. That's what delta gives us. Delta not only tells us the leverage that we're getting, meaning if the stock goes up by $1, how much does the value of the call option go up by, but it's also an approximation for what is the probability of the stock being above that strike price at expiration. So it can really serve two purposes here. And this is how many traders, before we had platforms like OptionsPlay, we used to have to do mental math using these types of numbers to give us an approximation as far as what is the probability of a stock being at a certain price sometime in the future. So with this particular delta, I would choose something roughly about a 225 here on Facebook, which is trading at 206. So what this is saying is that if I choose 225, there's about a 15-17% chance that the stock will be above 225, or about a 17% chance that my stock will get called away on this covered call. So that's how you would use delta, but that's how you could use, or this is the general method as far as how do you go about selecting a strike price for your cover calls. And someone's asking 6 to 7% out of the money. 6 to 7%, is going to be very different. The reason that we never use percentages is because 6 to 7% on a stock like Facebook might be a decent move, but 6 to 7% on a stock like Tesla is going to happen every day. So you never want to use percentages because percentages doesn't account for the fact that some stocks are more volatile than others. So that's why we never ever use percentages. We always use delta because delta always accounts for the volatility. So for example, here, if I use Facebook, which is trading at 206, the 17 delta is roughly 20 bucks away. If we look at Tesla, that same which on Facebook stock is about 10% out of the money. So for Tesla to look at a 17 delta, look at how far I have to go for that. On delta for the same June expiration, the 17 deltas are 1,020. So the stock's trading at 803. That's a strike price 220 bucks away. What is that in percentage terms? That's more than 25%, roughly 20, 22, 23% away. So that's why we never want to use percentages, because different stocks have different volatilities and you don't want to just use percentages. Always use delta. Delta accounts for the fact that Tesla is more volatile, so it naturally selects a strike price that's further away. And then for stocks that are less volatile, like Facebook, it's going to select strike prices that are closer. Okay, so that's why we always use delta. Short puts, same thing, same type of expiration, 30 to 45 days is a general good starting point. And then, but when you're coming to selling strike prices on short puts, and this is something that I covered in our beginner's course on generating income, is that when you're selling cover calls, you want to choose strike prices that are further away because you want to prioritize the capital appreciation of the stock that you own, because you own that stock because you think it's going to go higher. Make sure that you let that stock go higher before it gets called away. But when you sell a put, your primary objective is to own the stock. So you want to sell a strike price that's close to the current price. So when you're selling a short put on a Facebook stock, I would use probably the same June expiration, but I would choose something a much higher delta, usually maybe the 200 here in this particular case, which is a 37 delta. So only $5-6 bucks away from the current price. The cover call, I chose 20 bucks away. The cash secured put, I'm selecting about only $5 bucks away, because again, I want to own the stock. I'm also getting a higher percentage of the income here. I'm actually getting roughly about 3% of the underlying stock price, or about a 3% discount on that stock purchase by choosing a strike price close to the current price. Okay, so when we're selling cover calls and cash secured puts, that's how you go about selecting. That's your general rule of thumb as your starting point for selecting expiration dates and strike prices. So please type 7 into the chat window if that makes sense to you. Now let's talk about directional strategies, right? So let's talk about buying a call, buying a put, and perhaps debit vertical spreads, which are slightly more advanced. This is also something that we covered in our beginners options trading course. We covered both buying calls and puts, and we talked about how you can improve your odds of winning by turning your long calls and puts into debit vertical spreads. So we'll talk about both, but generally speaking, whenever you're buying a call or a put, you generally want to start 45 to 60 days out or greater. That's your starting point. Now, again, it really depends on your time horizon. So for example, if you have a view that a stock is going to go higher over the next 6 months, obviously a 45-day option is not going to cut it. You're going to have to buy a longer dated option, but starting point 45 days. And whenever you're thinking about strike prices, you always want to start with the strike price that's at the money. So 50 to 60 delta or slightly in the money is usually a good starting point. So for this Facebook example, I would use something like, I wouldn't use the same expiration date. I would use a longer dated expiration date, perhaps the Junes or the Julys possibly here. And if I'm buying a call option, I would buy here the 205s, which is about a 55 delta, the first in the money option. Now, one of the things that you'll notice is that OptionsPlay actually does this for you by default. So if you click on Facebook for OptionsPlay, we'll automatically select the expiration date and strike price for you based on what I'm teaching you here. So look, it automatically selects the June 26, 205 calls, because that is everything that we're teaching you here is already automated into the platform. So this is done for you. This is one of the benefits of having a platform like OptionsPlay is, right now what I'm doing is I'm teaching you the concept, but the platform itself actually does the work for you as far as giving you these starting points, okay? So call options, Generally speaking, 45 to 60 days out as a starting point, 50 to 60 delta. Buying a vertical spread, like we discussed in our beginners options trading course, is just a slight variation of buying that call or put. You're just improving that call or put odds a little bit by selling that out of the money option. So you're still always going to buy the same expiration date, same strike price, but what you're going to add to it is you're going to sell an out of the money option. And we're always going to sell a relatively far out of the money option, which is the 15 delta. So something that only has about a 15% chance that the stock is going to hit that price or higher. Because when you're selling a vertical spread or when you're selling an option, you're giving up gains above that strike price. So you don't want to cap your gains too early. That's why we always choose a strike price that's relatively low probability of hitting, but still generates enough income that offsets a significant portion of the cost of that trade. So just to give you another example here, so what I would do is I would buy, if we go to the June 26th, I would buy the 205s, which is again that 55 delta that we refer to, and I would sell something like around maybe a 227 and a half, roughly the 15 delta here, or perhaps the 230 here. And again, OptionsPlay does that work for you. So as you can see here, it automatically selects a 205, 230 call spread, because what we're doing here is we're paying that $11.10 for the 205 calls, but we're going to sell the 230 calls against it and collect $1.18, which offsets about 10% of the cost of the trade. So you're reducing your risk by 10%. What you've done is also you've reduced the cost of that trade, which improves your break-even price. So if you just bought the call option, your break-even price is $216.10. So the stock has to move about $10 higher for you to break even. On the vertical spread, your break even now improves to $214.92. So the stock only has to move about $8 higher for you to break even. So the stock obviously has a higher probability of moving $8 higher than $10 higher. So you have a higher probability of profit. You've reduced your risk. And we talked about time decay being one of the factors that really offsets the gains on a long call. So when you're trading a vertical spread, not only are you long an option, which has time decay working against you, you're short an option as well, which has time decay working in your favor. So you actually negate a part of the time decay factor, which means that when you're trading an option like a vertical spread, you're not as time sensitive. You don't need the stock to move as quickly in order for you to be profitable. It can actually move a little slower because you have time decay working slightly in your favor. It's still going to be working against you, but not as much as if you just had a long call position. And that's why we're such big fans of using debit spreads when you have a directional view in the underlying stock, especially if you think the stock's going to make a decent move to the upside, because it really reduces your risk, it reduces your capital outlay, which means that you'll be able to trade them with less risk. Okay, so that's a general rule of thumb for how to select debit vertical spreads. So now let's talk about selling credit vertical spreads. So this is the more advanced strategy. This is something we're going to discuss more in depth next Thursday. This is a strategy that we've been using a lot over the last few weeks as the markets have been recovering a little, but volatility is still relatively high. For those of you that have joined us here on Friday mornings, on Tuesdays and Friday mornings, we've been talking heavily about these types of strategies. But because when we're selling a vertical spread for a credit, our predominant leg here is actually selling an option, because when we're buying an option, our predominant leg here is buying the option. So the leg that has the highest delta is the buying. When we're selling, we're doing the opposite, where the predominant leg is selling. So because of that, we generally choose shorter dated expirations, usually about 30 to 45 days out as a starting point. You always want to sell an at the money option. You want to sell an option that has the highest amount of premium in this particular case. And this is one of the few exceptions for when you're selling that you're not selling out of the money. But I will say that most of the time when you're selling a credit vertical spread, you're not exactly selling the 50 delta. Many times you're selling maybe the 45 delta or 47 delta, somewhere slightly out of the money, but still very close to at the money. And then what you're doing is you might be buying back roughly about a 25 delta. So something that's far out of the money, because when you're selling an option, you have unlimited risk, right? So whatever you're selling, whether you're selling a call or a put, you have unlimited risk. So the reason that we're buying that out of the money option is to offset that unlimited risk factor and make sure that we cap our risk. So again, this is something I'll be discussing more in depth next Thursday. So I hope that you guys will join me where we're going to talk a little bit more about credit vertical spreads. It is a slightly more advanced strategy. It takes a little bit more work to manage these trades, but can be very useful in market environments like the one we are in right now. So whenever you're selling vertical spreads, these are the types of parameters that you generally want to use. And we'll talk a little bit about that more next Thursday. So those are the types of strategies that you might come across and how you might apply what we taught you here today. Now, this is by no means a comprehensive list of the different strategies you might be trading. There are plenty of option strategies that you might want to trade that we didn't cover here today. Diagonals, calendars, butterflies, iron condors, but they all follow the same general rule of thumb that we discussed here today, which is that when you're selling, you want to sell shorter dated options. When you're buying, you want to buy longer dated options. Now, this doesn't necessarily dictate how far out or how short you need to sell. This just means that when you're looking at an options chain and you're maybe thinking about, should I buy the Junes or should I buy the Julys, that you have a way to decide which one's actually better for you, right? So sometimes when you're buying an option, you're saying to yourself, well, I could buy the Junes, I could buy the Julys. And then you'll remember, well, if I'm buying an option, I should probably prioritize buying the longer dated option. Vice versa, if you're selling that option, you might sell that June instead of that July option, because you'll realize that if I sell a June option that only 36 days away, I can generate more premium by doing that twice than if I sell a single July option. And then when you're thinking about strike prices, the general rule of thumb is that whenever you're buying, you generally want to buy at the money or slightly in the money. And when you're selling, you always want to sell generally out of the money. So again, like I said, none of this stuff is rocket science. It's really not difficult to learn. It's certainly not difficult to understand. It's just sometimes very counterintuitive when you're looking at the options chain, because you were taught to buy low, sell high. And when you're looking at an option chain, you see these types of rules, it's actually the exact opposite. But these are the reasons why you want to choose the expiration dates and these strike prices. And that's what I wanted to cover with you here today. So I hope that this was useful in helping you guys better understand, especially for those of you that are newer to options and you find navigating a thing like an options chain a little difficult. But one of the things I will say is that we built this platform to make that process easier for you, but we still want to teach you why we select these expiration dates, because we get a lot of questions sometimes. People will say, well, I typed in I don't know, Goldman Sachs into I typed in Goldman Sachs into your platform, and I don't know why you chose these strike prices or these expiration dates. And this is really why. So we built this tool to automate these things that we used to do every single day manually into our platforms, and just gave it to us and spit out the results that we were looking for, so that we didn't have to, every single time we were bullish on Facebook, have to pull up an option chain and look at the right expirations and pick the strike prices. It did it automatically for us. And we built this for a reason, because we wanted to make our lives a little easier. We wanted to automate the picking of expiration dates and strike prices, so that we can just get into the work of analyzing the strategies instead of having to pick the expiration dates, then analyze, then go back to picking. We just wanted to automate this and make our lives easier. And we built this platform so that you can also experience that as well. Whether you're trying to buy or sell because you are bullish or bearish, or if you're looking for income using such as cover calls or cash secured puts, we do this all for you. That's all completely automated for you, so that you can select cover calls or cash secured puts. So remember how we were saying I would sell maybe the June 225s here. Notice how here it selected the June 5th 220 calls. It automatically does that for me based on what I just taught you. Same thing for puts. It selects that June 197.5. I think when we were looking at it manually, I was selecting roughly about a 200 strike, but this does that work for you, so that you don't have to necessarily remember everything I taught you here today. It just automates that process for you. So that's really why we created this platform. That's why I wanted to show you these rules here today and lay them out for you and show you, if you were using an options chain, how you would do it. But more importantly, also demonstrate how our platform automates it all for you. So thank you so much for taking your time out here this afternoon. I hope that you find this useful. At this point, what I'll do is I'll open this up for Q&A so that you guys can ask some questions. So please, if you can type your questions into the Q&A window as opposed to the chat window, simply because there are too many chats at this point for me to, there are hundreds of you here attending, and I really appreciate so many of you coming every single Thursday. But unfortunately, the chat window just gets a little too messy. So if you can please type your question into the Q&A window, I'll try to answer your question as through that Q&A window. So thank you so much. Let's see. Do you have a link for tomorrow morning's webinar? Yes. So we actually have a link. If you want to attend tomorrow morning's session, which is what we do every single Tuesday and Friday morning, it's at 9 a.m. I'm going to post it into the chat window. It's trade.optionsplay.com/weekly. We'll go over the markets. We'll talk about what we currently see in the markets. We'll talk about credit spreads, all of that stuff. Please just sign up using the link on your screen here. In your hedging seminar, I took a note that when it came time to hedge, you recommended going out 72 months. Robert, I don't believe that that is correct. First of all, I don't think there are options listed 72 months out, and I certainly don't think I would ever say to do that. Whenever you're hedging, we generally say 2 to 3 months out. Not 72 months. What does it mean when theta for an option is 200 or 300? Theta is usually measured in terms of dollars per day. So if you have a theta of 200, that means that you're going to receive $200 for every day that goes on. So I don't know exactly what strategy you're looking at, the price of the option at that point, but theta is quoted in dollars per day. I'm interested in buying call options on TSX. My window's 1 month. When should I close to sell this option? So generally speaking, when you're buying an option, you never want to hold it to expiration. You want to generally, want to sell that option before expiration, because when you're buying an option, so even if you buy an option that's out here, right? So let's say you initiate a long position here. As it gets closer and closer to expiration, you're going to see the value of that option evaporate. So in the last few weeks, you're going to see the value of your option evaporate quite quickly. So which is why whenever you're buying an option, you generally want to find yourself exiting that within 2 weeks of expiration. That's why we want to buy 45, 60 days out, so that you hold on to, so that you have enough time to hold on to it, so that 2 weeks out before expiration, you can sell it and not hold on to the option in the last couple of weeks, okay? And before I continue to answer any more questions, I just want to again say thank you to everyone, and I hope that you guys consider supporting us, because that allows us to continue doing this, sending out weekly, daily trade ideas, doing these weekly education webinars, doing the Tuesday and Friday morning sessions to keep you guys updated as far as what's currently going on. Membership is just $75 or $500 a year, and you can sign up using the link that I just posted into the chat window. I hope that you guys support us to continue, allow us to continue doing this into the future. Let's see. More questions. I know there are a lot of questions here. I'm going to try to get to as many as possible. What about the weekly options? So from our perspective, it doesn't matter whether you trade a weekly or a monthly option. They are identical from an options perspective. The one thing I will say is that many times the weekly options have more strike prices. I like trading the weekly options because I can fine tune my strike prices. Sometimes the monthly options, there aren't that many strike prices, but from a trading perspective, they're identical. Would you recommend selling longer-term options if one thinks the stock is overpriced and is going to decline? No, I would still sell shorter-dated options because I can collect more premium selling shorter-dated options than I can sell longer-dated options. So why sell longer-dated options when you're not going to, because you shouldn't think about just how much premium you're getting. You should think about how much premium am I getting per day that I'm short that option, because every day you're short that option, you're taking on risk that the stock goes higher. So you want to get paid for that risk per day. You got to think about how much are you getting per day. The longer dated options, you're going to get more premium, but you're getting smaller income per day. Could you please show how to place an order when you're selling? I mean, I can show you on my platform, but it doesn't really matter if it's on your platform. On my platform, I just hit the bid price. I can select my price and I can click on confirm or send. All I have to do is click on the bid price to sell. Generally speaking, most platform works that way. Okay, let's see. There's so many questions here. Why would you not sell the 30-day option twice? I think that's exactly what I'm suggesting, is that if you instead of selling a 60-day option, you should sell the 30-day option twice. That's exactly what I'm suggesting. In OptionsPlay, it seems that expirations out greater than 45 days on a call vertical are almost rated less favorably. Do you think they are a less good choice? Bruce, I don't know that they would be rated less favorably by much if they are. You know, so for example, here, if I go to Facebook here, you're saying that if I bought a, the Junes are 86. Let's see what the Julys are. If I go down to July. So, I mean, the two are basically identical, right? So I don't really see, you know, maybe if you go further out in August, August, I don't have as many strike prices. Why wouldn't I have enough strike prices here? Let's take a look. Let's go out to September. Yeah, so I don't really see a difference in terms of, you know, from one expiration to another. So I'm not exactly sure. Maybe you're talking about a different stock where maybe the volatility is a little different. So sometimes you might be looking at something where it's more, maybe there's an earnings coming up. So the longer dated options have that earnings cycle built into it. So it has a lower score. That's possible. But generally speaking, you're not necessarily going to see a significant difference from one expiration to the next. How do you determine strike prices for vertical spread? So I think I covered that both debit and credit here, George. What if you're just playing the premium changes? If you don't mind answering, giving me a better example of what do you mean by playing the premium changes? But that's exactly, I think that's exactly my point, is that if you're just playing for premium changes, then you want theta in your favor. So if you're buying an option, you want to buy longer dated options. If you're selling an option, you want to sell shorter dated options, because premium changes in your favor is one thing, but time decay is always going to be there. So you might as well put time decay in your favor. And the only way to do that is by what I'm showing you here today. Bruce is saying, when buying a call vertical, how do you select the spread of the strike prices? So again, we usually use delta as our peg to determine which strikes do we want to buy or sell. What about if the price moves against you when you buy an at the money option? As opposed to any other option. So whenever you buy any option, if the trade goes against you, you're going to lose, right? But when you're buying an out of the money option, you're going to lose even more because of the time decay. So you always have that risk whenever you're buying an option that the trade goes against you, but you're going to have less time decay on the at the money options, which will become in the money options if the trade goes against you. Would you recommend selling longer term options if one thinks the stock is overpriced? Would you recommend selling longer term options? So Satish, no, I don't. It doesn't matter whether you think the stock's going in one direction or another. You should always sell the out of the money option. I'm sorry, shorter dated options, not longer dated options. What does debit spread expiration date? That does mean debit spread expiration date should be longer dated than credit spreads. Yes, that is correct. When you're buying a debit spread, you should generally choose a longer dated option than when you're selling a credit spread. So Jesse, your question about HYG, please send me an email at info@optionsplay.com. I'm happy to try to answer your question, but I think it just gets a little too much for me to answer that in a few seconds here. How do you calculate delta? I'll be honest, if you really want to do that, you can certainly Google it. I don't think you really want to, because no one wants to calculate delta. Let the platforms do it for you. I don't think you necessarily want to go into the Black-Scholes formula and learn how to calculate delta. You can, it's not a pretty formula. For credit spreads, which leg of the spread are you checking for delta? Or for both legs, you're selling the 50 delta and you're buying back roughly about a 25 delta on a credit spread. How do you find delta for a vertical spread? I'm not sure what you mean by the how do you find delta for a vertical spread, but the delta of any multi-leg strategy, you just add up the deltas. That's how you find the delta of the total spread. What does the options play represent? The options play score represents not just the risk to reward, but the probability of you making money on that risk to reward. So think about, like, it was inspired by poker players, because poker players have, you have um, the amount that you're risking versus your potential reward, which is the size of the pot. And then you have a probability of winning your hand based on the hand that you have, which is very similar to an option strategy, right? Option strategies have risk to reward. You have a max reward, which is what you can potentially make. You have a max risk, which is what you can potentially lose. Then you have a probability of profit based on your break-even price, right? So it's really calculating your odds of winning based on those three factors. And you have to factor all of those things. You can't just look at probability. You can't just look at risk to reward, because if you just look at one of those, you're missing half the picture. Now, the problem is that just by telling you the max reward is 2,400, your max risk is 1,500, and your probability of profit is 33, guess what? That's hard to crunch those numbers in your head. That's why we created the options play score. And the options play score, you don't have to memorize it. It's color coded for you, so that if you have something with a really high options play score, it'll be green. If it's yellow, that means you have a very average risk reward ratio. If you have something that's red, maybe something like that, then it's telling you that you have relatively poor risk reward ratios. So it's really designed to give you a better understanding as to whether or not you have an edge from an options probabilities perspective. Could you please tell us how the options play calculates the options play score? I think I just covered that on that previous one. After hours, the premium show on options play the closing prices. Yes, after hours, we're showing you the closing prices. Is it possible to print out your PowerPoints? Absolutely. So we send you the link not only to the recording, but also the slides. It's at the bottom of the recording emails. You can, every single week we send it to you, and you can download them and you can print them out. It's all available to you. Recommendations for buying or selling into earnings. Bob, Harley, I'm not exactly sure what you mean by that. Like, you mean a specific stock? I mean, we do have a separate webinar every single quarter on earnings, but 90% of the S&P stocks have already reported earnings. There are not a lot of big ones coming up. Lowe's is coming up. I'm sorry, Home Depot and Lowe's are coming up, but we just closed out a Home Depot position. I do quite like Lowe's right now going into earnings, but I haven't quite taken a look at it too in depth yet. We'll take a look at it after we finish here today. Would you buy an option with a lower strike price than one you would sell? Doesn't that put you at greater risk of the stocks between the two strike prices? No, not at all, Stephen. I'm not sure what you mean by that, but it doesn't add any risk to it at all. Whenever you're trading a vertical spread, it doesn't matter where it really ends up at the end of the day. I mean, first of all, you close out these trades before expiration anyway, so you are not any greater or less risk depending on where it is in between the two strike prices. Why not sell a 7 to 14 day credit spread as opposed to 30, 45 day? The reason that you don't want to sell a 7 to 14 day credit spread is because of gamma risk. Gamma risk gets really tough, or gets really high in those last 2 weeks. So that's why we generally want to avoid selling a credit spread or selling any type of at the money options at expiration, because gamma turns your delta into a very binary event. You can either win all of, you can have your max reward or max risk gravitates between the two very, very quickly when you're at the money near expiration. So that's generally why we avoid selling credit spreads that are that close to expiration. Why doesn't options play automate credit spread strategies? That is something that we are working on. We actually have some work on that right now. The reason that we don't automate credit spreads is because credit spreads are a much more difficult strategy to trade, and you don't always find optimal credit spreads. So they are much rarer than finding debit spreads that you can generally trade on most strategies. You can't just find a credit spread on every single strategy, but we are working on some algorithms that can produce some of these that we're really looking for, and especially provide us with an edge on credit spreads, because you shouldn't just always sell credit spreads. You should only sell credit spreads when you have an edge, and that's part of why we don't automate it. But again, we are working on some reports that tell us when credit spreads do provide us with an edge, and that is something I plan on showing you guys here next Thursday. At what point do you typically sell your call if profitable? If you're talking about a long call, our general rule of thumb is that when you've reached about 75% of the premium that you've paid, so about a 75% gain, that's usually time to start taking partial profits. If you have multiple contracts, if you only have 1 or 2 contracts, you generally want to take all of those profits. In the options play, the spread suggestions have always strikes that are very wide and make the trade very expensive. Why is that? Eduardo, exactly the reasons that I showed you here today is exactly why we choose those strike prices, because you want to optimize your spread. This is based on our back testing the most optimal spread. You can trade something that's cheaper, but that's going to provide you with a very low delta. So if you trade something like this, if you trade a 205, 220 or 205, 215, it'll cost you less money, but this has a very low delta. So basically, if the stock goes higher, you really don't make a lot of money on this particular trade. So you're really not taking advantage of the leverage that options gives you. Here, I'm only making a max reward of 400 while I'm risking 600. That's not the risk reward ratio you want to have when you're trading options. Options, first of all, have a low probability of profit. You only have a 41% chance of winning. You don't want that 40% chance of winning to win less than what you're risking. That's why we don't want to trade spreads that have too narrow of a spread when you're trading a debit spread. How can delta possibly factor into the current craziness of the market? Well, it does. So for example, if you look at Facebook right now, the 20 delta is, let's go back to Facebook. So the 20 delta here on Facebook is 225, which is roughly 20 bucks away, right? Let's go back. That's a great question. Let's go back to Facebook before the sell-off. Let's go back to, let's say, January 31st. Whoops. Let's go to the end of January. And what we're looking at, we're looking at a 36-day option for Facebook. So let's do similar, March 6th. Whoops. Let's remove all of this stuff. This was when this was when Facebook was trading at 201. That delta, that 20 delta was at 217.5. So this was less than 16 bucks away. So when things were more quiet, that 20 delta was only 16 bucks away. When things are a little bit more volatile, and maybe this isn't even the best example because Facebook isn't that volatile right now. But if we went to, let's say, so on January 30th, when things were quiet, the 20 delta was roughly 16 bucks away. Let's go to February, let's say March 2nd, when things were really volatile, right? Let's go out roughly same thing. Notice how the 20 delta then, when the stock was at 196, this was at 212. That's what, 18 bucks away. So I don't know, is March 20th the best? What are some of the best examples of when things were really volatile? Yeah, let's look at February 27th. On that day, the 20 delta was 202, which is 23 bucks away. So delta automatically adjusts for the craziness in the market. The more crazy the market is, the further away it is, the less crazy it is, the delta naturally adjusts for that. So that's exactly why we use delta for all of our strike price selections, because it accounts for the craziness in the markets. Why are single leg options always have a lower score than two leg options? Because of exactly what I showed you, right? So single leg options risk more. They have a lower probability of profit. They have a better, the break-even price is further away. You're risking more money, which means that you have less potential reward. Those are all the reasons that factor into your risk reward and probability calculations. And that's why the single leg strategies will always have a lower score. Here I'm risking $1,000. Here I'm risking $9.92. If the stock goes to, let's say, I don't know, 220, here I'm making 526. Here I'm making 604. Would I rather risk 992 to make 604, or would I risk 1,070 to make 526? I think the answer is pretty obvious, and that's why the OptionsPlay score here is higher. Gold credit spread. I'm not sure if that's a question, Ernest. If you have a question on that, please type them into the chat window. Tony, before we get to the step of picking an expiration date and strategy, what's the ideal setup or the major factors that OptionsPlay use to determine if they will execute an options trade on a stock? I would say liquidity is the first thing, and then direction. Liquidity and direction are the first and foremost things that you need to determine before you decide whether or not you even want to trade an option on it, because an option is just a vehicle of which you express your views. But you first have to have a view, and you should have a view on a stock that's liquid. So that's why we have the liquidity report here at the bottom of your screen. If you click on it, it gives you access to all of the liquid options for that specific day. We update this twice a day. So as you can see here today, we have 165 liquid options. So I generally start my research using this link every single day as a starting point. And then I look at directional views within that list. So those are the things that I generally look at first. Great question. How does this translate to weekly options? Again, weekly and monthly options are exactly the same. The only thing you want to focus on is, am I trading a long or short dated option? Is there a link to your chart page to get to the education area? Education area. So you can click on Learn to Trade Options here at the bottom of your screen. It takes you to our YouTube channel. All of our previously recorded videos are on our YouTube channel. You can click on videos on our YouTube channel, and you can see all of the. This is actually the wrong channel here. Let me show you. The OptionsPlay channel has all of our recent videos. You can play them all. You can see the recent market outlook sessions. You can see our analytics, all of our education. They're all here on our YouTube channel. So I highly recommend you to subscribe, and that will give you updates every single time we post a new video. What is the logic to come up with trade ideas? Trade ideas are all based on technical analysis scans. George, you're very welcome. Why not the weekly instead of 2 week? I'm not sure what you mean by that, Bruce, if you don't mind clarifying. Explain vol. Vol is just volatility. The more a stock moves, if a stock moves a lot, it is more volatile. If it does a lot of this, it's more volatile. If it just stays like that, sort of tight, it's less volatile. That's all it is. Just how much does the stock move? What type, if any, signal do you use to make sure you are getting your direction right? So, I mean, I'm not fancy. If you join me on my Tuesday or Friday morning sessions, generally speaking, I use RSI, and predominantly I use the price action. I don't use any indicators, if you will. I use a simple moving average, and I use the price. The price tells me first and foremost everything. And then if anything, indicators give me a confirmation. So I'm looking for, if the stock is continuing to move higher, that's my bullish trend. I need to make sure that momentum indicators are confirming that, which they're not doing that right now. This is something that we've been talking about for quite a few weeks, which means that we're cautiously bullish on the markets, and we prefer to be selling premium here in this particular environment rather than buying, because buying means that we think the stock's going to make a big move. And I don't think that's going to happen because the momentum is not confirming the price. But price is always first. That's the first and foremost in determining your directional move. If I'm selling the 50 delta at the money and buying the 25 delta, this is referring to credit spreads. Your credit spread collected is a nice big chunk, but doesn't that limit your probability of profit? Ron, great question. So Ron's question is basically saying that if you sell and at the money option, you're collecting a bigger premium, but you have a lower probability of profit. But Ron, that's exactly what we're looking for. Our back test tells very clearly shows that if you sell really far out of the money credit spreads, so let's say you do something like this, and you sell these really far out of the money credit spreads, they have really high probability of profits, like 75, 80% probability of profit. Your risk reward is so poor that yes, you might be that type of person who wins 80, 90% of your trades, but all it takes is that 10% of the time when the stock moves against you, where you wipe out more than what you've gained in the last, 8 to 9 trades. We see that over and over again with people trying to prioritize high probability of profit. And again, this is what I'm saying. High probability of profit tells me that you're thinking about this in the wrong way. You're only looking at half the picture. And when you miss the other half of the picture, that's when it gets really dangerous. When you only focus on probability of profit, you forget how much you're risking to take on that probability of profit. It becomes disaster in the long run. We've seen people blow up their accounts doing types of strategies like this, especially people selling SPX credit spreads that have 95% probability of profit. They're collecting $100 every single week and they think they're happy until that 1 week where they wipe out $10,000 of their account in a single trade. I unfortunately have seen that way too many times, and I will tell you that in the long run, doesn't make sense. In the short run, it sounds fun. It sounds fun to win 95% of your trades, but it means nothing if you just blow up your account, that 5% of the time when the trade goes against you. What is the cost of the platform? The platform is just $75 a month or $500 a year, which you can sign up using this link here on your screen right here, which I'll post again into the chat window again. Ram, yes, you can get the slides. We will email them out to you with the recording. Are you going to upload this webinar? Yes, all of our webinars are uploaded to YouTube, including the slides that are sent to you afterwards. Ron's asking, after trade is on, is there a way to see your option contract will be, where your option contract will be hypothetically on a certain day, not expiration, if price moves to a certain different value? Yes and no. It depends on what platform you have. Different platforms provide that. Thinkorswim, Charles Schwab's Street Smart Edge. Most of the active trader platforms provide such a tool. Not everyone does. It really depends on who you trade with, Ron. When selling options, the shorter the expiration, the better. Then why don't we just always sell weekly options? We generally do. We generally just sell weekly options. But again, weekly options, if a monthly option expires in 3 weeks, it's the same thing. Weekly option is just a name. It has nothing to do with, the type of contracts or anything like that. So if you like to sell 30-day options, whether that 30-day option is a weekly option, a monthly option, a quarterly option, it doesn't matter. As long as you sell an option that's short dated, that's the only thing that matters, Dave. Thanks for closing the loop between theory and tool. You're very welcome. I really hope that was able to do that for you. Does the platform show delta and implied volatility? It does. You can click on the blue share button for any strategy. Click on explain strategy in Greeks. Will show you delta, theta, gamma, and vega. Implied volatility is right here on your P&L simulator. It shows you the current at the money implied volatility of an option. How do I get access to the OptionsPlay school? How do I get access to the OptionsPlay tool? Do I need Thinkorswim? No, you do not. You can sign up using this link here that I had at the beginning of the webinar. I will post this to you. You can sign up for a free 30-day trial using trade.optionsplay.com/join. Do you have any debriefs or commentary on the daily play? So yes, we do talk about that pretty much on our Tuesday and Friday morning sessions. So please join us for that. On the options play, how do you calculate the score? That's something we already discussed. Tony, wonder whether I can download the PDF copies. Yes, you can. That will be sent to you after we finish here today. Does the trade ideas change daily? Yes, it does change daily, and it happens after the market close, usually around 6:30, 7 o'clock. Do you find 6:30 to 7 o'clock Eastern? Do you find that the most Do you find that most verticals go to expiration, or do most get closed prior to expiration? I would probably guess that the number is closer to about 80 to 90% of spreads are closed prior to expiration. The vast majority of them are closed prior to expiration. I'm interested in buying at the money call options. My window 1 month. When should I close to sell this option with respect to expiration date? So first of all, I recommend going a little further out than 1 month, but you always want to close it out, usually about 2 weeks before expiration, Mohammed. Randy, what do you think of trading weekly credit spreads on SPY? Risky? No, not at all. I'm a big fan of it, but I will say that when you're selling credit spreads on SPY, there's usually not a whole lot of edge in that. You basically have to rely on your directional view. You're not getting much of an edge from an options perspective. Please explain the best way to select the best bullish or bearish ideas in OptionsPlay. Great question. So, I mean, this is something that we've done plenty of webinars on. We always start with your sector, view. So we have a watch list. You can sort the sector based on the technical score. So financials and industrial are some of the weakest sectors right now. Technology and healthcare are some of the strongest sectors. So what you generally want to do is, if you want a bearish view, you want to select from weak sectors, and then you might go into the financials. You might see what are some of the weakest stocks within financials. And then you want to choose some of the weak stocks within financials if you're looking for bearish opportunities. And if you're looking for bullish opportunities, you might go into technology and look for some of the strong stocks here, like VeriSign or Autodesk or Intuit. Intuit is another one that I was looking at earlier today. But that's generally how I try to find my opportunities, is looking for strong stocks in strong sectors or weak stocks in weak sectors for my ideas. Are there any restrictions you have when looking at options when it comes to Delta Vega, high volatility with high delta? I'm not sure what you mean by restrictions that I have. I don't think I have any restrictions, but I do have certain rules of thumb, which we went over here today. The OptionsPlay score is a measurement risk reward. So no, it's not a 94% chance of success. It's just telling you that whether the risk to reward and the probability are weighted in your favor, kind of average, or against you. That's what the OptionsPlay score is meant to tell you. It has not to do with the probability of success. You can click on the OptionsPlay score and you can look at the metrics to see what the probability of success is on each strategy. How do you manage your trade if it's working in your favor? Do you just sell one leg? No, on a spread, I always sell both legs at the same time. Wayne says he's been using OptionsPlay for 2 years. Thank you very much, Wayne. Thank you for supporting us. I really appreciate that. What is your principle on taking profit 50, 60, 70%? It depends on what strategy you're referring to. When you're buying an option, 75% is usually a good starting point. If you're selling an option, it really depends on which type of strategy you're selling. So if you're thinking about credit spreads, that's what we're going to discuss next week. Can you get assigned if you buy or sell a vertical strategy? You can, but I will say that on the debit spread, very rare. Credit spread, more often you will get assigned. But keep in mind that an assignment on a vertical spread does not change the risk of the strategy. So even if you do get assigned, it doesn't change the max risk or the max reward. It just changes your margin requirements. So if you're selling a credit spread and you get assigned, you would have to have the margin to be short or long the stock. That is something you have to consider, but it doesn't change the risk of the stock. Does it allow for setups to be placed with a broker? So currently, we do not allow that for you to do that. What will we get sent to us automatically? Slides. So we get the recording and the slides sent to you automatically, Leonard. Canadian options, you can access OptionsPlay through Canadian options at tmx.optionsplay.com. It's free of charge, courtesy of the Montreal Exchange. But again, that free version is limited to just Canadian options. Arnold, hi Tony. If you're using a debit spread, is it equivalent of covering your options, or do you still have to buy the underlying stock? You do not have to buy any stock when you're trading a debit spread. You don't have to own the stock. You don't have to want to own the stock. That's the beauty of trading a debit spread, in my opinion. It's one of the simplest strategies. You have very low risk of assignment. You are basically purely playing a directional view. You've leveraged your capital. You have good risk to reward ratio if you are right. And if you're wrong, you're risking relatively small amounts of capital to do so. And that's why it's one of my favorite strategies to trade. The current market has very volatility. Will that affect expiration dates and options to choose? Yes. So like I said, Delta naturally adjusts for volatility. So it naturally selects further away options to sell. Market volatility is a factor into all of these models. When you own that long call option, do the shares automatically get assigned an expiration if in the money? If you loan that long call option, if you're a long call option, you have no shares and there is no assignment. You get to choose whether you want to exercise that call to take the shares, Carlo. To view the webinars, do you need to be a member? You do not. To view the webinars, you just have to go to our YouTube channel. You do have to be a member to access this tool, though. Can you explain the importance of volume and open interest in buying calls or puts? I would say that open interest and volume is really not an indicator that you need to use at all. We use the bid-ask spread. The volume and open interest means nothing other than if someone else is trading it. But whether someone else trades something has no meaning to you. As long as the bid-ask spreads are tight, that's the only thing we care about. And we factor that into our options liquidity, right? So this options liquidity factors into the size of the bid-ask spread, and it gives you which ones have the widest bid-ask spreads, which ones have the tightest bid-ask spreads. The ones with the tightest ones are up top. The ones that are wider are at the very bottom. What is rolling? When do you roll over? Rolling is when you sell your current position and put on a new position in a single strategy. That's it. That just means that you want to make an adjustment. Either you want to change the strike price, you want to change the expiration date, and you're trying to change that trade, change that in a single expiration date. You're just closing, let's say, your June option and buying a July option. That's what rolling is referring to. Do you use leaps, and if so, when? Yes, I absolutely do. It's when I have a long-term outlook on something. You know, we actually have a whole webinar on utilizing leaps in your portfolio. I highly recommend you to look at that up on our YouTube channel. How to deal with market going against your short position, roll, buyback. So Bernard, I recommend that you take a look at, my webinar from a few weeks ago on managing risk and money management. If a trade goes against you, sure, there might be ways that you might want to repair it, but they all take on more risk. I recommend that you simply, or ask yourself, if you weren't already in a losing trade, would you place another trade on that stock? If the answer is no, you should just simply cut your losses and move on. If the answer is yes, then still cut your losses on that original position and then put on a new position. Detach yourself from the losing trade on that second trade, because that's how you get yourself into trouble, by continuously trying to repair a losing trade. That's how you get yourself into bigger holes and bigger holes and bigger holes. And that's how I see people blow up their accounts. So if you intend on trying to repair a trade, close out your first losing trade, put on a second trade. But think of those as two separate trades. Most of the spreads on the platform are about 30-35% pop. Is that the target? It's not that that's a target. That's just what the probability of profit on debit spreads are. But they have 2-to-1 risk to reward ratios. So if you're right, you're going to win double of what you're risking. So if you have any directional edge, if you are able to call the direction of a stock 55-60% of the time, that's your edge on the specific trade. How do you cope with long expiry dates when the market drops down, then skyrocket back up, like we have seen in the last 3 months? Your option pick moving from at the money to out of the money, but in the money again in calls, and contrary and puts. I'm not sure what do you mean by how do you cope with that? I would say that most of my trades don't last that long, where I'm holding on to a trade through that type of market volatility. Most of my trades usually last no more than a few weeks. So I'm not in that particular category. I do have some longer term bets that I put on after the crash, but I usually don't take on those types of long-term views unless there's types of sell-offs like we've seen. So I will say that I tend to be more of a shorter term trader, so I don't necessarily sit through most of that. I do have long-term investments that I don't really touch, regardless of market volatility. That's more investments in ETFs. Those are for my retirement accounts. So, I don't really care about short-term market volatility in those types of positions. As are deltas picked for each strategy and OptionsPlay based on a particular formula or used consistently throughout the platform? They are used consistently throughout the platform, Tyler. You mentioned delta, the probability stock goes to that price. How do you interpret IV? IV is just the annualized return, annualized probability of the stock moving that amount in a year. So if you have an IV of 26%, that means there's about a 68% chance that Facebook stock is going to be 20% higher, 26% higher, or 26% lower. That's your range that you expect the stock to trade at. That's how you interpret IV. On a weekly option, when do you sell to close a call option? In a weekly option, when do you sell to close? 2 to 3 days before expiration. I guess that really depends on whether the option's in the money or out of the money option. If you're buying, first of all, I don't recommend you to buy a weekly option because you're basically going to let that time value is going to decay very quickly. So I don't recommend you to do that. But if you do buy a weekly option, you should definitely sell it as quickly as possible. Can you explain the red, yellow, green sticks under the charts on the platform? That's just the 1 month and 6 month trend, and it shows you how that's changed over time. So as you can see, that basically it's telling you that here on April 17th, the things turned bullish here. The trend of this stock turned bullish here on April 17th. Okay, guys, I really appreciate everyone taking the time out here this afternoon. There were so many questions, and I really appreciate everyone taking the time out here to learn and participate and field your questions. And I'm really happy that I was able to get to as many as I did. But unfortunately, we are running out of time here today. So thank you so much for attending. Again, I really hope that you guys find this useful and you're able to join us tomorrow morning at 9 a.m. where we're going to talk about the markets. Things look a little dicey this morning, but things really turned around this afternoon. So we'll update you on kind of how we're positioning for this particular market, what type of risk we're seeing, and we'll send you the recording here for today's webinar in about half an hour here. So thank you so much. I hope you guys have a great evening, and I look forward to seeing you guys here tomorrow morning. Have a great night.